I'm here with Shen Wong at Clear Trust Mortgages, and we're talking about mortgages today. Hey, Shen.
Hey, how's it going, Nick?
Maybe you could just tell me a bit about Clear Trust.
Yeah, so Clear Trust, we are a brokerage that's under the DLC umbrella. So we do have a few offices across Canada. So we have a couple offices in Alberta. So we have an office in Calgary, Edmonton. Also, we have an office in Toronto as well, too. So we are nationwide. And we are, I would say, volume-wise, numbers of broker-wise, we are one of the biggest brokerages in Canada.
Get into the first question then. A lot of folks got a mortgage 4 or 5 years ago when rates were lower. What's the best strategy for renewing your mortgage at these high rates today?
Yeah, I personally find, and I think this is a popular opinion with most of borrowers, is to go with the 3-year fixed rate. Now, the 3-year fixed rate, it's not as long as a 5-year, of course, but it does give us that time to, try to predict what would happen within that 3 years. Of course, the 3 years is slightly higher. The spread between a 3-year and a 5-year rate right now, we're talking, it's not a huge difference with most banks. Even one of the banks that I looked at yesterday, we're talking about only a 0.1% spread. So of course, as interest rates go down, it's good to have a shorter term. So that way, when you do renew into another term after the 3 years, hopefully we get a much lower rate at that point, right? So I would say that's the most popular strategy right now. And let's say if we're looking at a 2-year term, we're talking about a percentage more. So I think with that big of a difference, you might as well go for the 3-year term, save that money. And let's say if you are capable of paying that extra payment, what you can do is you can use your prepayment privileges, of course, if your mortgage does have that feature, to pay that additional amount. So you pay off your mortgage slightly faster. And that will shorten your amortization as well, too.
Is that the mortgage product you're writing mostly right now?
Yeah, I would say probably about 80% of my clients are going for the 3-year fixed.
3-year fixed.
Yeah. And it also seems like the banks are giving the largest discount on the 3-year fixed as well, too. Because sometimes we can go back to the lender, try to get that rate lower for our borrowers. Yeah, I would say definitely most popular, and yeah, it's probably the best strategy we have right now.
What types of lenders are you working with typically when you're shopping for products like this 3-year mortgage?
Yeah, most of the lenders that we're working with, in particular for the 3-year mortgage, I would say it's all A lenders, or prime lenders is what we call it as well, too. So those are the big banks. We're looking at, TD, Scotiabank, HSBC, and also smaller lenders as well, too. So we have lenders which are called monoline lenders. So monoline lenders are good when it does come to insured deals, meaning that if we have a client that's putting less than 20% down payment and they need mortgage default insurance, these monoline lenders, they do offer lower rates than big banks majority of the times. So that's why I turn to these monoline lenders. But for their strategy, they typically offer the promotions mostly on a 5-year fix, but sometimes they do have the promo on a 3-year fix as well, too.
I think there's some people that are curious. So if you get to a mortgage renewal, and of course rates are much higher now, what's the possibility you're going to get denied?
I mean, the possibility with a big bank or a monoline lender, I think the chances are slim. They don't do any qualification. They don't have any requirements when you do need to renew. Basically, I would say it's just the banks will give you options. You can ask for options as well, too, if you want 2-year, 3-year, 5-year variable. However, if you haven't made your payments on time, of course, that can be a concern. So the lender may not renew you, or if they find that any finances or, if you've lost your job, they do have the right to not renew you. But that rarely happens. And I think one of the reasons why is it takes a lot more for a bank to go out there and obtain a new client. So the renewal process to retain a client, it's much lower cost. So I think as long as you're paying your mortgage on time, there are no concerns. They're more than happy to renew you.
think secretly the market kind of expected a rate reduction today. So talk to me about your expectations for rates in the next year.
Experts from the big six banks that rates are going to drop from 1% to 1.5%. Now, National Bank, they are the exception where they're thinking the overnight rate right now is at 5%, and they're thinking it's going to drop to 3.25. So 3 of those banks did say that we're probably going to see a 1% drop. So Bank of Canada is going to drop the overnight rate by 1%. And the other 2 banks out of those 5 that I just mentioned, they're going to drop the rate by about 1.5%. I personally think it's going to be closer to 1%. I think inflation is going to be an uphill battle to try to get that number down, especially in December. We did see that increase. So inflation is a little stickier than we thought.
What does a mortgage broker look at to qualify you for a mortgage?
We take a look at credit report, we take a look at income, we take a look at liabilities, down payment as well too. What we do is we go through a process called debt servicing. So basically the ratio is based off on the expenses to the income. Now, most banks like to keep that under 44%. However, some banks, they do have guidelines saying that if you have 30% down payment, we're able to stretch it up to 48%. Or if we have, a certain credit level, we can go up to 48%. So yeah, that's a process called debt servicing. And of course, we need a satisfactory credit score as well too from the client. But also there are some lenders that have, for example, like a net worth program where we're able to stretch up that ratio as long as a client has a certain amount of assets. So we can take a look at that as well too. So each lender is a little different, but I would say, it comes down to debt servicing, and typically it's about 44% for your expenses to your income. That's the maximum that we can really go up to.
What's the minimum down payment you would need to qualify for a mortgage?
Yeah.
Today.
So the minimum down payment, if we're talking about purchasing a property under $1 million, we're looking at 5% of the first 500,000. The remainder from 500,000 to $999,999, we would need 10% on that remaining balance there. Anything over $1 million, we would need at least 20% down payment. And some lenders, all lenders, I would say, have a sliding scale. So how the sliding scale works is that if we go past a certain amount, let's say, for example, if we're buying a property that's $2 million, some banks may want 20% on the first 1.5 million, and the remainder from 1.5 million to $2 million, they would want 40% down payment on that. So that's called a sliding scale. So depending on the situation, it's always a little different, but yeah, that's generally how it works.
If you're less than 20% down payment, you've got to pay mortgage insurance, right?
Yeah.
How is that calculated? How much is that, and how's it calculated?
Yeah, the mortgage insurance, it works by a percentage of the mortgage amount. So if we have 5% down payment, from 5% to 9.99%, we are looking at a calculation of 4% on the mortgage amount. 10% down payment up to 14.99%, we're looking at 3.1% of the mortgage amount. And now 15% to 19.99%, we are looking at 2.8% of the mortgage amount. So the higher down payment, the more down payment you have, or the higher percentage of down payment you have, the lower the mortgage default insurance would be. So that's how it's calculated.
Perfect. I don't think I've ever heard it laid out so clearly. Would you suggest buyers buy with less than 20% down or save up to 20%?
If a buyer is capable of buying, especially their primary residence, it's good to buy as soon as possible. I mean, you always hear people say the best time to buy is now, and I truly believe in that. Especially in Vancouver, real estate prices are going to go up in the long term. We're going to see peaks, valleys. We're going to see prices dip as well too, right? But I mean, it's important to have a place to live, to have that shelter. So if you do have, let's say, the minimum down payment, if you're buying a place that was, let's say, 500,000 and you only had 5%, it's not a bad idea to get into the market. And I think a lot of people are concerned about, paying that mortgage default insurance cost, but it can be financed. However, you do get a lower interest rate. Now, why you get a lower interest rate on the mortgage default or on these mortgage default loans is the banks, they prefer these types of loans. It's a safer investment for them. If the borrower does default on these loans, these lenders, they get their money back, right? So they prefer these types of loans, and they're more than willing to offer a lower interest rate for mortgage default insurance mortgages. Let's say if you're in that range of 5, 10%, it might be a good idea to get in a market, pay that cost, because let's say if that goes up to 50,000, then you will earn a lot more in equity, that appreciation in that property compared to how much you have to pay for that mortgage default insurance.
Right. So even if you're not at 20%, it still might make sense to pull the trigger on something.
Exactly. Yeah.
Okay. Last question. Why work with a mortgage broker? What are the advantages of working with a broker? And are there any fees to working with a mortgage broker?
Yeah, we have access to many different lenders. As I mentioned on this call, we do have access to big banks. We have access to monoline lenders as well too, which are the smaller lenders. And for specifically mortgage default insured mortgages, they do offer lower rates. We do have advantages with alternative lenders when it comes to self-employed individuals. And of course, these alternative lenders, they do have different guidelines as well too. We talked about ratio a little bit earlier. They do have higher ratios, which allows you to borrow more. But of course, these alternative lenders, they do have higher interest rates. So it's left us to us mortgage professionals to determine what the best solution is, within the lenders that we have. And of course, we have private lenders as well too. So I would say we're more of a one-stop shop, where if you come to us, we have more solutions available, where we're better prepared to take a look at all the different solutions. A lot of people are under the assumption that, they have to pay me a fee, but I typically get compensated by the banks. If it's a complex situation, there are some mortgage brokers that do charge a fee. However, I would say, like basically all my clients that I help them, when I help them, there is no fee charge for my services.